we were looking at the goods market model. We were talking about the main components of the model. We started off talking about the total demand for goods or aggregate demand, which is represented by C. We talked about it's made up of consumption, investment, government purchases, and net exports. And then here we talked about that. We started off, then we said we wanted to analyze each component of demand, where we started off by talking about consumption, where we where we looked at how in this model, we're going to assume that consumption is a linear function of disposable income. Now let's look at how we're going to model investment in this model. For now, we'll assume that investment is exogenously given. What do we mean when we say that investment is exogenously given? This means that we're assuming that it is not being determined within the model, but rather the model is taking it as given externally. And when we say an exogenous variable, we put a bar on it like this. So we're going to write investment as I is equal to I bar, which means that investment is exogenously given. It's not determined within the model. The model takes it as given. We do relax this assumption later. But this is assumption of a standard goods market model. The third component of demand in our model, like we saw, was government spending G. Now, together with taxes T, G describes fiscal policy, which is the choice of taxes and spending by the government. Now, just like investment, we'll assume both government spending and taxes are exogenous in our model, i.e. they're not determined within the model, but rather the model takes them as given. So we can write G is equal to G bar, T is equal to T bar. Now, the reason we assume that G and T are exogenously given is, number one, by allowing G and T to be exogenous, we can look at the policy implications of alternative spending and tax decisions from the model. For example, we can see that if G or T changes, what does our model predict? And also another reason why we assume G and T are exogenously given, because the government's behavior is not as regular as consumers of firms. So there's no reliable rule we could write for G and T, because the influence of politics and international relations makes modeling the government's actions rather complicated. So these are the two reasons why we typically assume in our goods market model, G and T are exogenously given. We will look at an extension of our model in which taxes will have a part in which taxes are partly autonomous, T naught, in which they're partly exogenously given, T naught, and partly are proportional to income, which is T1 by right. So they have a part which is independent of income and a part that depends upon income. So we'll look at a variant of our goods market model where we assume this form of the taxes rather than T's T bar. So here it's also important to note that when we talk about G, right, G is government purchases. G does not include government transfer payments because G represents government spending on goods and services, and transfer payments are not made in exchange or return for currently produced goods and services. So transfer payments are not included in G, which includes government spending on goods and services. Rather, transfer payments are included in T, because even when you are talking about a consumption function, if we go back, when you were talking about a consumption function, there, if we recall, we defined T to be taxes paid minus government transfers received. And over there, we did acknowledge that while for short, we will refer to T simply as taxes, but always keep in mind that T are taxes paid minus government transfers received, so it's net taxes, right? Taxes minus government transfers. So in our goods market model, transfer payments are not included in G, rather they incorporated in T, which is defined as taxes made minus transfer payments received. Although for short, we will always just refer to T as taxes, but we do need to keep in mind this also includes transfer payments. The last component of total demand for goods in our model is net exports, and we're going to assume the economy is closed. That is, it does not trade with the rest of the world, which means that exports, imports, and hence net exports are zero, and net exports are the difference between exports and imports. We will expand our model for the open economy in the future, where we look at the goods market model for the open economy. But to sum up, our behavioral assumptions for the standard or what we call the basic goods market model are, we assumed a linear consumption function, C0 plus C1 Y minus T, where Y minus T is disposable income. So we assume that investment is exogenously given for now, and we'll later relax this assumption. And when it comes to fiscal policy, we looked at G, and we looked at that we're assuming G and T are exogenously given, and we looked at two reasons why we typically do that. And we'll later look at an extension of a model in which we'll relax the assumption that taxes are fixed. And then as far as the foreign sector is concerned, we're assuming that it's a closed economy, and we will expand a model for an open economy in the future. So these are the assumptions that we make, behavioral assumptions that we make in a standard or basic goods market model. Now, it's very important to remember that assumptions are critical in macroeconomics. Different assumptions change dramatic nuances. So these are the assumptions for a standard or basic goods market model. We will later look at other variants of the goods market model. We will relax some of these assumptions and look at the implications of that. But these are the core assumptions that we have in a standard goods market model, where we assume a linear consumption function, We assume investment, government spending, and taxes are exogenously given, and we have a closed economy, so net exports are zero. But we will relax some of these assumptions to see the implications of doing that. So when we're looking at total demand, so we know the general case is that total demand for goods or aggregate demand is Z is equal to C plus I plus G plus NX. Now case with our assumptions. So given our assumptions, like we said, we're assuming a linear consumption function, C naught plus C1 by minus T, where T is just T bar. So instead of C, I can write C naught plus C1 by minus T bar. And for I, like we said, we're assuming I is equal to I bar. So we have I bar here. And for G, we're assuming G is equal to G bar. So we have G bar here. And now we can rewrite this by combining the terms that don't depend upon Y and combining the term that, and so we can basically rewrite this by combining like terms, by combining together the terms that don't depend upon Y here. So it's C naught minus C1 T bar plus I bar plus G bar, and then we find here plus C1 bar. Now this part which does not depend upon Y is what we call, this part of demand that does not depend upon Y is what we call autonomous spending. It's that part of demand that does not depend upon Y. In other words, the amount of demand when Y is equal to zero. So this is our total demand for goods or aggregate demand with our assumptions, where it has a part which does depend upon Y and it has a part that does not depend upon Y. And that part of demand that does not depend upon Y, we call that autonomous spending. So this is our first component of our model, total demand for goods or aggregate demand, where we saw in general it's C plus I plus G plus NX. But given the behavioral assumptions that we made in our standard goods market model, that you have a linear consumption function, investment, government spending, and taxes are exogenously given, and it's a closed economy where net exports are zero. So this is how we define total demand for goods. So this wraps up our first main component of our model. We'll now, in the next video, look at the second main component of our model.